If you want lower premiums, you don't start by shopping harder. You start by understanding how underwriters actually price your business, because once you understand the levers, you can influence the cost without cutting protection. Hi, I'm Marty with JMW Insurance Solutions. We help business owners protect what they've built and keep insurance costs under control by aligning coverage and risk the right way. Most business owners experience insurance pricing like the weather. It just happens. Premium goes up and it feels completely out of your hands. But pricing isn't random. Underwriters price risk based on specific inputs. Some of those inputs are market-driven, but many of them are tied directly to your business operations and your risk profile. If you understand what underwriters are actually looking at, you can do two important things. You can reduce the chance of unpleasant surprises at renewal, and you can position your business for better terms over time. Let me break down the pricing process in plain English. An underwriter is really trying to answer one question. How likely is this business to have a claim? And how expensive would that claim be? Everything they do is an attempt to estimate frequency and severity. So the levers you can influence are how your business looks on paper, how predictable your risk appears, how well you control losses, and how credible your documentation is. Let's look at the main inputs underwriters use. The first one is industry and operations, what you actually do. Some industries carry higher claim frequency or severity than others. A contractor, a trucking company, and a professional office do not price the same because the exposures are completely different. But even within the same industry, the details matter. What services you offer, where you operate, whether you work at heights or handle heavy equipment, whether you transport people or high-value cargo, whether you handle sensitive data. Make sure your operations description is accurate and clear. Confusing descriptions create uncertainty, and uncertainty almost always costs money. The second input is payroll, revenue, and business size. Many coverages scale with the size of your business. Underwriters use payroll and revenue as exposure bases when they're pricing. If those numbers grow but aren't updated cleanly, it can lead to audits, adjustments, premium surprises, or being underinsured without realizing it. Keep your payroll and revenue reporting accurate. Clean numbers build credibility. Third is location and property characteristics. For property coverage, insurers look at building construction type, age and condition, roof type and age, fire protection, security measures, and proximity to hazards like wildfire zones or flood areas. You can't change your zip code overnight, but you can improve your risk profile with upgrades and documentation. Document improvements and maintenance. Underwriters respond positively to businesses that manage their facilities. Fourth is claims history and loss patterns. This is one of the strongest signals underwriters use. They'll review how many claims you've had, the total amounts, and whether the same issues keep repeating. Even small claims can matter if they show frequency. Frequency tells the underwriter that losses are likely to continue. Reduce frequency through simple prevention systems, safety routines, driver programs, documentation, and regular maintenance. And when claims do occur, handle them cleanly. Fifth is management attitude and documentation. This one is subtle, but it's real. Underwriters respond to businesses that have clear processes, can provide documents when requested, maintain safety standards, show consistent training, and have incident reporting procedures in place. When a business looks organized and proactive, it looks less risky. Create simple documentation, a safety policy, a driver policy, incident reporting, maintenance logs, a claims kit. None of this has to be complicated. Sixth is coverage structure, limits, deductibles, and endorsements. Higher limits cost more, lower deductibles cost more. Certain endorsements and specialized coverages add cost, but here's the important point. Cutting coverage to lower your premium can be a trap if it creates gaps that end up costing you far more later. Optimize structure intelligently. Choose deductibles you can actually pay. Set limits that match reality. And focus on reducing risk rather than stripping protection. Here's the mindset shift that matters. If you want to influence cost, think like an underwriter. Ask yourself, if I were insuring this business, What would worry me? What would reassure me? What would prove that risk is being controlled? When you can answer those questions with documentation and simple systems, you become a better risk. And better risks get better options. Before your next renewal, update your operations description and exposure numbers, review your claims patterns, and implement at least one prevention improvement. Create a simple claims kit and safety policy. Document property maintenance and upgrades, and review your deductibles and limits for smart alignment. Here's the bottom line. You can't control everything in the insurance market, but you can control how your business presents risk. And over time, risk control is the best way to stabilize premiums without cutting protection. If you'd like us to review your policies with an underwriter's lens and identify the highest impact changes, visit us at jmwinsuranceSolutions.com/business insurance. We'll help you find the improvements that actually move the needle.